Hi, everybody. Thank you very much for joining the Trading Tuesdays webinar with myself, Kathleen Brooks from Forex.com. Just before we get started, I just want to remind you guys that I work from only one monitor when I do these webinars, unfortunately. So unfortunately what I'll do is when I bring up the charts, it means I can't see you or what you're answering. So if I don't answer your questions in a timely manner, please do feedback periodically. And there may be a bit of delay in me answering them, but I will endeavour to answer all questions that you have. Now, just while we get started, let me just double check that the camera's working and you guys can see my chart. Just bear with me a moment. Just double checking that you can all see this chart. This is a gold chart. It's a 60-minute chart with an RSI there. Just double checking if you see it. Sadman, can you just let me know if you can see the chart? Okay, brilliant. It seems like it's fine. Great. Let me just turn that off quietly. Okay, great. Well, we're going to start in one moment. I just thought that I would just give you a little tiny bit of context of where we are now. Obviously, you know, throughout the summer we've had this big rally that was propelled higher at the start of this month by that OMT program that was announced by. What we've seen in the past week or so, or nearly 2 weeks now, has actually been a slowdown in that rally and a lot more consolidation take place. Now that is important for the market. Even in an uptrend, consolidation still takes place. You get periods of consolidation. Obviously, the length of this period of consolidation has got more people worried that maybe what it is instead is actually a bit of concern in the markets, or a bit of a lack of conviction. Which could mark the top of the rally. So that's a bit of concern. I was certainly in the, there are certainly concerns in the markets on a fundamental perspective. For sure, we've got big concerns around growth worries, stalling growth in Europe and the US and China, obviously, the kind of the big three economies in the world. When that really is limiting the rally at the moment. So really, to get this rally, to propel it forward, certainly for the next few weeks anyway, we need to see that ECB OMT program get activated. And, for that to happen, obviously, especially for a bailout. So now, as traders, the biggest question that we should be asking ourselves is, when will Spain apply for that bailout? And there are various beliefs. Obviously, Spain presents its 2013 budget on Friday. It also releases its bank stress tests. We think that if any of these things are received badly by the market, then what we could get is a lot of pressure on Madrid to actually go and accept that and go and request a bailout, which would then trigger that OMT program. So we are watching out for that nattering on. Let's go straight to our charts. I'm not going to start with gold, even though I am going to talk about gold because it is obviously very important. This is euro dollar. Let's start with euro first. Again, I will check periodically. Now I can't see you guys because I'm just looking purely on the chart. If you have a question, write it down, and then I will endeavour to answer it. And I will check periodically every 10 minutes or so, about 3 times during this webinar, to see if you've got any questions. But if I don't answer promptly, please ignoring you. I'm not. I just can't see you. So let's get going. As you can see, euro dollar. This is a daily chart. The last few days, certainly since the end of last week, we reached that high of 131.50. We've come off sharply. We've come off since then. I wouldn't necessarily say sharply all the time. We've had a few bouts of sharp declines. But it's been a nice meander lower. We're now below that 130 handle. Obviously, that's important. You can even see that from this chart that 130 was a very important level. Caused an awful lot of congestion there earlier this week, late last week. And we've kind of warmed it up. We have meandered lower. Now, if you can see, we have bounced off lows at 128.70. That seems to be very, very good support there, ahead of 128.50. That we could potentially trade in a bit of a range, because today, remember, we don't have much economic data out. Merkel is speaking right now. She is speaking to an industrial conference, so there is a bit of macro talk going on. Actually, Mario Draghi, the head of the ECB, is at that conference. We don't expect anything massive to come out of it. We don't expect, certainly no new policy changes or no new direction shifts from Merkel or Draghi. We expect them to reiterate what they've said before. So we're not looking for short-term volatility. But what you can see there is that, really, certainly in the last day or two. You know, we've managed to find a base around 128. 70 or 70, 80. We've bounced a little bit back from there, and we do have this 50 as a kind of capping gain. So very, very tight range, really. But as I said, not too much economic data there to really propel things anymore, or further anymore, which is another kind of cause of. It suggests that we could trade sideways. Obviously, you know, as I said, if we do get an OMT, we think the activation of the OMT program through a Spanish bailout would be warmly received by the market, and that could see us getting back to 131.50 in euro dollar, maybe even above there. I'm just going to check here. It seems like you're okay. You know, getting above this 131.50 high from the kind of the end of last week or start of last week. You know, that's going to be important to us, but we do think the downside is capped. You know, 127.50, if we do fall below 128.50, the low from the 11th could be, or one of the lows on the way up, could be a good support area. I'm just going to show you their daily chart as well. This is clearly rejected that level. There is a lot of support there. This 128, where is that? So this red line on the chart is just above 128.50. That is a massive, massive level. It is the 200-day moving average. If we are to fall below there, that does suggest a bit of acceleration on the downside. So, you know, there are a few levels that we're watching. We're fairly neutral on euro dollar at the moment, but if we do get that break below the 200-day moving average, so below this kind of 128.50 level, then we do think, you know, that would accelerate our downside, and we could see quite a lot of kind of bearish momentum take over. We could see a decline back to that 127.50 mark, maybe even to the 100-day moving average at 126.85. That also kind of caps that would also be kind of good support. Let me just draw this line for you. Sorry, this is a drawing tool. This is a different e-signal chart system that I use compared to my usual one, so it doesn't look quite like I use it to. But as you can see, like 127, so we've got this kind of 128.50 mark here, the 200-day moving average. Then you'd be looking 127.40, and then even kind of 126.50. We do tend to think that we are still fairly well supported above 125, because we think that the ECB's OMT program has limited that tail risk. So we could actually rally on the back of it. But as I said, obviously we have turned lower. We have clearly rejected that 135 mark. We've clearly rejected 130. But we would say that potentially the markets are again, but it's all about when Spain will apply for that bailout. So again, you know, there are a few dates that we could watch, and obviously the pressure may grow on Spain to do that at the end of this week once we get its bailout announcement, or sorry, once we get its budget announcement. If the market is disappointed with its budget or its sovereign or its bank stress test, the latest in a saga of bank stress tests. Sorry, just bear with me one moment. Sorry, I thought I was going to sneeze, but it doesn't seem like I am. The pressure will be so intense on Spain to accept a bailout that we'll end up doing so in the week after that, or certainly in the coming couple of weeks. And we could see another rally, so potentially back towards that 130, 150 mark, maybe even up to 133. That would be kind of our key. Remember as well, when you're talking about euro, there's still a lot of people who are short out there. So any good news is sometimes met with some euro or some unwinding of those short positions, which is also euro positive. So, you know, that's kind of where we stand. But as I said, for right now, certainly in the next couple of days, we think it's a buy around that 128.50 mark, while it's a sell up above 129.50. So there's all in all about this is range trading conditions. You've got to get into range trading conditions. And if when you're in that situation, you buy the lows and you sell the highs. Really, that's kind of what we mean. That's exactly what we mean by when we say range trading. So, do watch out for that. Obviously, there could be, this is a period whereby, there isn't, markets are based on news. They are kind of, looking for new news to propel markets higher. And right now, we don't seem to, we certainly don't have that, at the moment. And that's, what we think, is going to kind of limit, like range bound. Now, oh, bear with me one moment. Sorry, didn't expect that to happen. Let's also take a look at cable. Cable is another cross I want to show you, because cable has really been taking advantage of this dollar weakness. So this dollar weakness that's been pervasive since that QE3 outlook from the Bank of England, from the Federal Reserve in the US. Let me just double check to see if you guys are there. Nice support there, I think. You guys were talking about euro dollar, maybe that 128.50 mark, maybe even that nice support from that trend line on the way up, and that indeed is true. So, that's why we're fairly neutral to see whether or not it will go back. We'll touch that support and then move higher. But just looking at cable, very different, very, very different chart here. Cable has been taking advantage, as I said, of that weakness that's in the dollar. It's managed to hold on to gains even when other markets have been jittery. So even when things like the commodity markets have been jittery and the euro. Now, there could be a couple of reasons for this. Number one, it's more of a long-term story. Let's go back to this monthly chart, as you can see, or even weekly. Go back here. Euro, the pound, or this cable rate, has never really recovered from its sharp decline in 2008. So that's if we see if people think QE3 as being a long-term game changer and a long-term winner, then they may think, oh, actually, cable offers some value here because it's been quite weak versus the dollar for quite a long time. Now, as you can see, this 163 area, which is where this red line hits, is a key resistance level. It's the 200-week moving average. So if we get above there, if we would get a daily close, especially a weekly close this week, above 163, that is going to be a huge movement for the market. It is going to be super important in the sense that we are going to see a lot of algorithms starting to buy up cable. It could also cause an awful lot of it could also cause a lot of people to get interested. So this is a longer term chart, and it's just showing you just how significant that level is in cable right now. Now let's take a look at the hourly as well. The hourly is smart. Well, actually, let's take a look at the daily. So as I said earlier, a different chart experience to what we're seeing to what we've seen in euro dollar. 163 has been targeted a few times. As you can see, we haven't managed to get above there. That's a significant level because it is the yearly high. The high from kind of April, May. If we get above there, then we'd break fresh highs for the year for 2012. So a significant move. And really what we need to see, we think, is if we get a close above 163.10, 20, that is a key level. As I said, that's a massive move and a new paradigm shift for this pair. However, what we've seen is a bit of a reticence to get above 163. A lot of congestion, as you can see here, really for the last week. When you see kind of these large upward shadows, it is a bit of a concern. Big upward shadows in candlestick charts, especially daily candlestick charts, can suggest that we're at top and that we're going to move lower. Now, we haven't quite seen that yet. We've been fairly well supported between 161.80 and 162.60 on the upside. Now, that is a key level. We're still fairly bullish at the moment. However, if we get a close below 162.60 today and maybe tomorrow, that would mean kind of 3 days of lower closes, and that to me would start to be worrying. I would worry about that and suggesting that maybe we're not going to get to that 163 level quite yet. Now, cable has obviously managed to hold on. If cable gives up the fight, the fight and gives up strength against the dollar, that could suggest an overall broader strengthening in the dollar. So, watch that because that's going to be really, really important. So, as I said, cable, let's just take a look at the hourly chart. And as you can see here, it just really shows it, a series of lower closes. Now, let me just draw that, because that's your kind of typical downtrend, right? Certainly in the short term is, lower lows. So again, if we don't get above that 162.60 level, then there's a lot of support. I'm not saying that we're going to fall off a cliff. There's a huge amount of support really all the way down to 161.50. We've kind of 162.25, then 162, then obviously 161.50 on the down. Should act very, very good support levels. So, that's certainly something to watch out there. The thing is with cable is that right now we don't know whether or not we've got the conviction to move it higher. It's an example of these convictionless markets. they can be quite difficult to trade. I wouldn't really get on the long side until we break 63.10, because I think we need to break this new level before I can be certain, or before I can have confidence that we're going to move into a new paradigm here. So again, no long positions in me until we break new yearly highs. Again, if we get a close below, 162, then I'd probably look to sell. Again, so that's kind of what I'm looking at right now. Now the other, let me just check this quickly. Okay, great. Let's take a look at Aussie as well. As you can see, really concentrating on the majors right now, because that's where a lot of the interest is taking place as we're waiting for these big events to happen, like will Spain apply for a bailout? When QE3 is job themes, that all has a big impact on how these things trade. As you can see, a bit neutral on Aussie dollar really. We're currently around 104.20-ish. There's very good support 104.40 ahead of 104 kind of 50-ish. This is a cluster of hourly SMAs. Now, if we get a break below this kind of level here, or this level here, this 103.60, that is the low from late last week, then that is a bearish movement for this pair. So right now we're neutral, as you can see, probably stuck in that range. We have a range going between 105 and 103.60. We're right now smack bang in the middle of it. So again, kind of convictionless market. I would probably look, I certainly probably wouldn't sell or establish a short position until we got below that 103.60 level, maybe kind of 103.50. I'd have a sell order out now, because I think if we get below there, then we could see further declines towards parity. But in the longer term, really between now and maybe even the end of the year, I see Aussie dollar trading within a range, a definite desire, a lot of support on the way down to parity. There are a lot of buyers at parity or even just above it, as you can see here. This 101.80 double bottom there signals a really nice reversal in this pair. However, we've also seen a double top above 106, around that 106.20 to 30 mark. I see that range as really persisting for the long term. Now, as you can see, this is a daily chart. There's an awful lot of support on the way down. There is support at this 103.30 level, as I mentioned, also 103.60. So that could be a bit zone. Possibly, definitely from looking at this chart, maybe what I'd do is establish a short position below this cluster of daily SMAs. So daily moving averages there, around about the 103.20 mark, looking for a move back to that 101.80. Maybe even down lower to kind of the 101 mark. As you can see as well, draw your attention to this RSI here, which is pointing lower as well. So that suggests that momentum is to the downside. It doesn't look like we're oversold at all yet. Look from an hourly perspective, the RSI, which is a good momentum indicator, some people use it as a good way to detect, strength of market sentiment. It is a bit of a lagging indicator, but it does certainly go some way to help you pick places when markets are losing sentiment and losing space, and really it's just showing us that we are moving sideways. So again, a sideways move, very, very normal in the current market, and that's why I probably wouldn't establish a trade here. I'd look for a break above 104.50 to target and move towards 40, and I would look for a break of that kind of 103.60 mark to target a break lower to the 101.80. So I'm kind of biased. Certainly in the short term, to a bit more of a decline. I think this dollar rally could have a bit further to go. However, remember, Aussie could turn around very, very quickly if Spain does apply for a bailout, because it's very sensitive to risk. It's a real risk-sensitive currency pair. Okay, the other thing I want to show you here is yen. I've only got a couple more charts to show you, and then I'll go back. I'm just going to double check to see if there's any. Okay, cool. Let me just get my drawing tool, bear with me. Dollar yen, this is the hourly chart. As you can see, we have had a whole session now below 78. 78 is a really key support, well, it was key support level below there now. It had also been a key resistance level, and the fact that we've broken through it so quickly and so cleanly has been a cause of concern. We've had the Japanese finance minister come out today, not happy with where it is. Basically below 78 does suggest there is intervention risk in this pair, and that the yen could there could be some selling pressure on the yen to weaken strength from official sources in Japan. Now, we tend to think that they may not actually do that until we break new lows. So maybe below that 77.25 mark, which is kind of was the low from earlier this month. And from a daily chart as well, we may want to break again below 77 even, which was the low from earlier this month, but also going back to May as well. Obviously, if we were to get back towards that below 76, that would be a key indicator that they're going to intervene. So expect volatility in this pair. Now, obviously, right now, there's a really nice trend going. We could see further declines. We wouldn't be surprised to at all. And it really depends. We've seen the Bank of Japan before not really react that strongly to, yen bulls remain fairly resilient to threats of intervention. So, any pullback towards maybe that 78.05 area could be sold into to really test the Bank of Japan and the Japanese officials' reserve towards weakening the yen. So, you could make like a nice 100 pips out of there if you think it's going to decline even further, but probably a better one to buy on strength, or sell on strength, sorry. And actually we see it kind of the Bank of Japan in the past, or the Japanese authorities have been fairly weak and fairly, ineffective at limiting yen strength. So we would say that resolve will be tested yet again. The other one I want to show you today is dollar CAD. Dollar CAD is interesting because there are retail sales coming out of Canada later, and obviously we are looking at every single piece of economic data. There isn't too much coming out of the US at 2 o'clock. There is Case-Shiller home price data for July. That may have a bit more significance because it's targeting the housing market in the US with its bout of QE3. As you can see, this pair has really broken higher very nicely. It's currently testing that 98 mark. A break above 98 could take us all the way back to kind of 99, 60 to 70, so this, cluster of hourly SMAs. But to see that, we really need to see a kind of a bigger bout of risk aversion in the markets. We don't necessarily think that's going to happen. We're looking at these hourly, and we think that this kind of 98 mark, 98.20 mark, is causing a lot of resistance. And if we don't get above there today, then we could actually be back towards that 97.50 mark to start with, and then potentially down to 97.25, which is the kind of the lows from last week. Let's also take a quick look at gold. Now, gold has been really interesting and is a bit like cable. I'm not willing to establish long positions right now until we get above those key prior highs. So the high from November 2011, let me just go to the daily chart. So this high here, and also February. I really want to see us get above 1805, or certainly get above 1795 before I establish a long. Purely because we've seen such hesitation around this 1780 mark. You'll see that very long upward shadow, which again, it's like flashing warning signals. Do be careful, do be careful. If we turn around lower, then we may get back down to 1730. That's a 21-day moving average, a really nice level of support. And then potentially we could even get lower again down to 1650. Now, a lot at conference yesterday, there was a bit of a debate going on about gold. Some people love it. They say, hang on a minute, all of this concerted effort by central bankers to pump liquidity into the economy, well, that's going to be gold positive. Well, you know what? In my view, it's only going to be gold positive if it does help the economy to strengthen. And if we don't, if QE3 falls like a lead balloon, a bit like QE1 and QE2 did, without triggering inflation expectations, then we could see gold actually meander lower. Now, I'm not saying fall off a cliff. I think it would be very well supported, but we may end up being quite range bound between kind of maybe 1550 and even 1750 throughout this quarter. So that's an interesting one to look at for sure. But again, I certainly won't be establishing any longs until we get above 1800. And actually, my mind is kind of telling me, my fundamental analysis is kind of telling me to be wary of long gold positions. However, obviously, I'll go with the technicals, and if we do break above this key level, then that's going to be important. I believe that if we do that, we'll have had to see either a risk rally and a broader dollar decline, which would be good news for gold. Someone's asked a really interesting question, Solomon. When prices reach key levels, is it safe to assume there could be a pool of liquidity of buyers and sellers which move the price up or down quickly? That can be one of the reasons, yes. Largely because with technical analysis, you're really trying to find out what is the street looking at. And so that's why you look at these big key levels. So, for example, 1805 in gold. You know, that's a massive level and super important. When we get above that level, it could trigger things like algorithms. It could trigger a lot of interest into this pair. As people think that we've got to another paradigm, people aren't going to necessarily establish long now at 1670 because there's a chance. The chances are too balanced. You know, it's probably a 60-40 that we might fall a bit further, especially if you think there could be further, maybe a negative surprise from Spain, or Spain doesn't apply for a bailout. We don't have that certainty. So I would rather establish my line on more of a, when I'm more confident that we're in a new paradigm and we're going to break higher. So for that, I'm not going to preempt a move above 1800. I'm going to wait for it, because I think if we get above 1800 or 1805, then really what we could see is another break higher, maybe even towards 1900. Now, again, as I said, that is going to be against what I think fundamentally, but I'm not going to fight the technicals and I'm not going to fight them at the market. That's my view. I'm going to wait until I break above that key level. Questions. I have finished all my charts, or looking through my charts. Please let me know if you've got some questions. I'd love to answer some. We've got about 5 minutes left, or a couple of minutes left. Someone's just said that the mic is still not perfect. Unfortunately, that's because I'm on a virtual desktop, so it's not a fantastic signal, but I believe that the sound is okay. It's cutting a little bit, but it is understandable. So you'll have to accept my apologies for that, and we'll just have to make do, I'm afraid, for that at the moment. Okay, everybody, it doesn't seem like there's any questions. Hopefully that means that I answered them all. Someone just said, why fundamental and technical are not compatible, which do you follow? Well, you know, as I said, I'm not going to fight the market. For me, you know, I think that, you know, I may think fundamentally that gold isn't going to be necessarily rally to $2,000 in the long term. However, the short term is telling me that gold is going to rally based on the technical. So in that sense, I'd put on a short-term long trade in gold, but I would put on a long-term long gold trade, because I don't believe in it. So, you know, I would, you know, when fundamentals and technicals aren't compatible, I would kind of look at your time frame. If the market is going with technicals, and go with it. You know, if we're breaking above key levels and that seems like it's adding momentum to the market, I would go with that. Even if I'm kind of, again, my fundamental analysis is telling me that gold isn't going to get to 2,000, I would have a short term. I would try to ride a rally in the short term, but I wouldn't have a long term, how much on it in the long term, you know? So you've got to be a bit pragmatic. Sometimes they do tally up, sometimes they don't, and that is the key thing. You know, what do you follow when you know the technicals and fundamentals aren't compatible? That's a great question, though. Okay, everyone, is that I think that could be the last question. We've just finished just a couple of minutes early, but thank you so much for joining. And again, I do apologize for the slight echo in the mic. But unfortunately there is nothing I can do about it, because I have to work from a virtual desktop, and the quality, it kind of compresses the sound, so the quality isn't fantastic. But thank you so much for bearing with me and for joining each week. I do really, really appreciate it, and if I can do anything to save or to solve this sound issue, then I certainly will. But thanks very much anyway. Patience with that. And please do join us again, not next week. Next week I am going to be here, but I'm going to be doing it on a different day, because I have a big meeting on next Tuesday, the 2nd of October. So we're planning on doing it. I'm sure FXG can tell us. I believe we may be planning on doing it potentially on Thursday the 4th. Just FXG, if you can put that notice up on the website. Also, I'll tweet it. So do follow us on Twitter at ForexCom. But yeah, so next week it's going to be a little bit later. But thanks so much, everybody. I hope you're all having a good week. Good luck trading this week. And please do join us next week, again, just on that different day. So maybe on the Thursday. Okay, guys. Thanks. Bye-bye.